Alright, Bitcoin, Ethereum, Dogecoin, NFTs. Everyone is talking about cryptocurrencies right now. But how do all these even get taxed in the US? In this video, I'll take you through the basics of crypto taxation, NFT taxation, and some tax planning tips to decrease your tax bill. So make sure to stick around until the end. The IRS views cryptocurrency as a property, and the disposition of a property usually gives rise to a capital gain or loss. Let me break this down. When you purchase some Ethereum, you can think of it as though you just bought a property. The purchase itself does not trigger any income tax or taxable gains. So if all you've done during the year is buy cryptocurrency, you absolutely have nothing to report, and you can probably skip to the next section of the video. In fact, the IRS clarified that you don't even need to check yes to the infamous virtual currency question on the first page of the individual tax return. But you will need to report a gain or loss on any subsequent sale. The IRS deems it a taxable event when you sell or exchange a virtual currency for another. The gain recognized is determined by subtracting the basis of the cryptocurrency, which is the price you paid for it, from the amount realized, which is the amount you received. So if you bought a Bitcoin for $10,000 and sold it for $60,000, your total gains would be $50,000. But if, instead of selling your Bitcoin for cash, you're trading it for 20 Ethereum worth $4,000 each, the amount realized, which is again the amount that you received, is now equal to $80,000 worth of Ethereum. So your total gains are now $70,000. The tax rate applicable to these capital gains will depend on whether they are long-term or short-term capital gains. And this tax amount needs to be paid regardless of whether you withdraw the cash from your trading platform or not. Just like stocks, the taxable event occurs on the sale and not on the withdrawal. The creation of NFTs has become a social statement, and many investors have turned to this asset class to make money. So how does this all get taxed? Well, it depends. For NFT creators, the minting of the NFT is not taxable. So everything you do from design, coding, or promotion of the NFT does not need to be reported. It only becomes taxable when you sell or exchange the NFT for crypto such as Ethereum. The IRS views this transaction as a trade or business, and as with all businesses, an income statement needs to be prepared. All revenue collected from the sale of the NFT, whether it's in the form of a crypto or other NFT, is taxable. The IRS is silent on this point, but presumably, expenses incurred related to the creation of the NFT could be deducted. The net profit is then taxed as ordinary income at a rate of 37%. As an investor who buys and sells NFTs with the hope that the asset will appreciate in value, your tax treatment is similar to what we've covered with crypto. No taxes or reporting on the purchase of the NFT. But again, any gains or losses on the sale or exchange need to be reported with the IRS. The gain is calculated by subtracting the basis of the NFT from the amount realized. This is super important, and I want to re-emphasize that every sale or exchange of NFT for another NFT or crypto is a taxable event. So make sure to properly track all transactions, including the amount you paid for as well as the amount that you sold for. So I'm going to share with you 2 planning tips that you could consider to legally lower your tax bill on your crypto transactions. The first one is by taking advantage of the long-term capital gains rate. If you hold on to a stock, crypto, or NFT for longer than a year to then sell it for a gain, this gain will be classified as a long-term capital gain, which is effectively taxed at 50% of your ordinary tax rate. In 2022, you'll pay 0% tax on gains up to $41,000, 15% on roughly the next $400,000, and 20% thereafter. Now, comparing this with the short-term capital gains tax rate, you can see how you could save 50% or more by just holding your crypto or NFT investment for longer than a year. This may not be something that traders can take advantage of, but if you're a long-term investor, please keep this in mind before selling. For the second tip, let's bring back our gain calculation. To decrease the amount of gains, and therefore taxes, you could either decrease the amount realized or increase the basis. But you generally don't want to decrease the amount realized as you want to sell at the highest price possible, so let's focus on increasing the basis. In the event where you purchase multiple units of the same currency, say Bitcoin, at different price points, the IRS has specifically allowed taxpayers the option to choose which coin they are selling. So if you bought a coin in January for $10,000, one in March for $30,000, and one in December for $20,000, you'll want to designate the March one as the one you're selling, which will ultimately decrease your taxable gains. And this is a classic example of tax deferral. Although you'll still have to pay the higher taxes when you sell your remaining 2 coins, what Finance 101 has taught us about time value of money is that money today is always better than money tomorrow. And that's been it. Thank you all so much for watching until the end. If you found this helpful, please give it a like for the algorithm and subscribe to my channel for more finance videos. I'll see you all in the next one.